Welcome to Investors Guide. Thank you so much for tuning in. Joining me in our Delhi studio is Kumar. And before we get to the rest of our episode, one of the things that we must make a note of is the change that we noticed in our Provident Fund accounts. Now, all of us who are salaried are aware of the fact that there is a deduction that goes out of your account every month that gets moved into your PF account. This account is managed by what we call the EPFO, or the Employers Provident Fund Organization. Now, in the last couple of weeks, the EPFO decided to move a small amount of that money into the equity market through ETFs. A couple of things we have to understand as investors. Does that mean your PF account is in any way at risk? Does that mean that your PF account will start to generate a higher income, perhaps through equity returns? These are the things we're going to try and clarify first before we move on to anything else. Dhirendra, if we actually first put the numbers into perspective, we know that the entire, the investment is worth 8.5 lakh rupees. We're talking about an incremental 5,000 crore rupees a year. And this is starting today, all of the fresh investments that come in, it's a small percentage of those fresh investments. So from an investor's point of view, when I look at my portfolio, does it make any difference at all to me whatsoever?
No, not really, because, it's going to be a very insignificant part of the total EPFO corpus. If you look at, 9 lakh crore, and incremental inflow is nearly 1 lakh crore. So the way the size is growing, and take that, take 5,000 crore getting into equity from here on, it will take many years for it to be anything which will get noticed. I'm saying, it is far from being meaningful. Even to get noticed, it is going to be, it will take many years. Unless the government has some thoughts that this is the starting point. At some point, they will actually earmark a larger allocation. Till that point, it is unlikely to have any bearing.
Just so we can spell it out very clearly for the people watching at home, if I am a salaried person with a PF account at this point, I don't take on any of the risk, or I'm not entitled to any of the returns that this small amount of equity investment generates. Isn't that true? So technically for me, nothing changes.
Yeah, nothing changes, because EPFO anyway is a black box. EPFO is not a mutual fund. EPFO is not run like NPS. EPFO is not run like a PPF with a guaranteed return. EPFO is a combination of benefit which you are entitled to for the mandatory deduction which your employer does, and deposits it, and deposits in your Provident Fund account with EPFO. As a result of which, a small part goes towards pension, a small part is your savings account, is your long-term savings, on which EPFO announces its return based on their investment performance. That too, I really wonder that there is clarity in terms of how it is arrived at. So, every year, EPFO announces a rate of return, and that is credited to your account for the next 1 year. So that is how it is. That particular premise does not change.
All right, so important things that you should realize about your PF account. It is not a guaranteed rate of return. That rate of return is set by the EPFO every year. It's announced, and that's the rate of return you get. Now, whether or not the EPFO is investing your money into the equity market makes absolutely no difference to your rate of return. You don't take on any of the risk, neither do you take on any of those returns. So if you have questions still about what's going on with your Provident Fund account, write to us on the email ID that's at the bottom of your screen. Now, before we start answering questions, I must remind you, later on the show, we will take a close look at the Reliance Tax Saver Fund. And in our final segment, we spend some time helping NRIs solve their tax problems. That's up later on the show. But right now, it's time for our portfolio question. Well, 30-year-old Sahil has written in. He tells us he has 3 goals, Dhirendra. He'd like to buy a house, he'd like to buy a car, and he'd like to save for his child's education over the next 15 years. He sent us his financial details. Some of it I'm happy with, some of it I'm not. He has 2 insurance policies. He has a life cover of 50 lakh rupees from Bharti AXA, and another insurance policy called a Wealth Protector from ICICI with a 5 lakh rupee cover and a 50,000 rupee a year investment. It does seem like, that fully hasn't been understood in terms of why he's bought that or why he's holding that cover. And the third thing that I worry about is he sent us what he says is a stock investment. He's invested in stocks, a 4.5 lakh nearly, and he's made a lump sum investment into stocks. So Before we go any further on the mutual funds, these are things we have to solve first. Absolutely out of the question to make a stock investment that's a lump sum, isn't it, Dhirendra?
Yes, stock is, one should be in stock only if one knows what one is buying, and one has the perspective, one has the fundamental perspective and time and inclination. If you don't have that and making a lump sum, and if you are, besides following all the key principles which any sensible investor will follow, which is diversify, be in a stock with full understanding of what you are getting into, and having the discipline to stick to it. I think a better way will be, going through mutual fund.
Well, Dhirendra, he does seem to have some other things under control. There's a 6-month worth of emergency fund in a bank account. He has health insurance from his employer. Now, Salil, you know that you need to have your personal health insurance policy, especially if you're planning a little addition to your family and you have dependents. You have to also buy a health insurance policy that is not your employer's policy. Let's take a look at his mutual funds, Dhirendra. Birla Sun Life, Top 100, Canara Robeco Emerging Equities, Franklin Build India, iPro Exports and Other Services, Reliance Small Cap. He wants to know if his portfolio is on the right track. Again, is this a haphazardly put together portfolio? Lots of thematic funds there. Would you like him to follow one of our portfolios instead?
Yes, his portfolio definitely looks haphazard with a infrastructure fund, export and services fund, and fortunately for him, all these funds have done exceptionally well. So he won't have to pay the price of learning through, building this portfolio. I think he should go with our aggressive growth portfolio for superior diversification, fairly focused approach. At the same time, he can do without that fixed income allocation in our growth portfolio, which is about 10%. Because he has his fixed income elsewhere.
All right, so on our screen right now is our aggressive growth portfolio. Dhirendra saying you don't need to use the fixed income investment, but remember the advice you're getting is to relook at your health insurance, your life insurance, and your stock investments. You'd be better off using mutual funds, and you can get back in touch with us if you need anything else. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. Dhirendra is with us as well. It's time to review the Reliance Tax Saver Fund, which means that it's also a reminder to you to start investing in your tax savers right now and not wait until January or February. Avan will give you a quick introduction on the numbers. Avan.
Thanks, Faye. The fund in focus this week is the Reliance Tax Saver Fund. Launched in the year 2005, the fund's performance has been inconsistent over the years. But how does the performance look in the recent past? Let's take a closer look at the performance in the last 5 years. Now, the red line is the fund and the blue line is the benchmark, the BSE 100. You'll see that the fund has performed better than its benchmark and category with a return of 22% in the year 2010. You'll also see that the fund has the ability to restrict its fall when compared to its peers in a market downturn. Although its performance has been disappointing in the year 2013 with a return of just 3%, the fund was at its best in the following year with a return of 83%. In the last 1 year, however, the fund's performance has dipped again with a return of 24%. You'll notice that despite having lots of ups and downs in its performance chart, the fund has had promising returns over the long term, making it apt for long-term investors. So should this ELSS feature in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Dhirendra, if we look at the Reliance Tax Saver, whether it's in comparison to its peers or it's in comparison to the rest of the funds that function like it does, it hasn't been very impressive. There are funds that are doing far better, especially in the last 1 year. Is there any particular reason to continue to hold on to this fund if my lock-in has opened up and I can, I'm allowed to pull my money out?
No, not at all. I think, this remains a very attractive fund. It has a small cap focus, and my sense is that, when you invest in a tax saving fund, most investors are getting locked into such a fund anyway. And this fund assumes risk and assumes the risk of, investing in small cap stocks. And it has been more than adequately rewarding experience for investors. So, if you look at 3-year, rank or 5-year rank, except for its initial 2 years since its launch, after its launch, it struggled a bit. Otherwise, I think it has been an outstanding fund. It has, 2014 was a kind of year where it actually made its presence felt. I think it's an outstanding aggressive fund, and most investors investing in tax-saving funds are getting locked in for 3 years anyway. So one should seriously consider, one should be assuming risk while investing in such a fund.
Well, Dhirendra, if I were to ask you to give it a star rating, it's currently 3 stars on Value Research, but on Investor's Guide, from an investor's point of view, would you place it higher then?
Yes, I'll absolutely place it higher, and I think it's a very attractive fund. I'll place it higher at about a 4-star fund, and it is more than adequately compensating for the risk that is assuming, which is dragging its risk-adjusted rating.
All right, 4 stars there for the Reliance Tax Saver Fund. Dhirendra Singh, it's an interesting, attractive fund because of its small cap focus, which means that you're going to be locked in anyways for 3 years because it's a tax saver. So you don't have to worry so much about that risk, because the longer you stay invested, the risk comes down. Let's move on now to our hold or sell segment. 42-year-old Hari has written in, Dhirendra, he has begun investing 14,000 rupees in mutual funds with a horizon of 10 to 15 years. He sent us a list of the funds that he has. They're all very, very good funds. The idea to, with this segment is to figure out whether or not they suit his time horizon. On the top, HDFC Top 200 and HDFC Balanced. Again, does he need, I don't know if he needs both of these funds, and among the two, which one would you like him to hold on to?
Both funds. Investing in funds, one should try and diversify even across types. So if I have to choose one and somebody is investing with a 15-year time frame in mind, I think it should be an all-equity fund, which is HDFC Top 200.
All right, HDFC Top 200. He's also written in, Dhirendra, telling us that he's a government officer, that these investments are for the future of his son and his family. So this is obviously something he's putting a lot of stock into. The other funds on his list, ICICI Prudential Blue Chip and ICICI Prudential Dynamic, both excellent funds. Continue with both of those investments?
Yes, both are very different funds. The Focus Blue Chip Fund is a fairly focused portfolio of large cap stocks only, whereas Dynamic is a very conservative fund. It changes with too many things in its portfolio depending on the outlook of the market. It is so yes, both are good funds worth carrying on.
Next on his list, Quantum Long-Term Equity, Dhirendra. I know you're going to tell him to continue this investment because of the lower cost, but I just want to clarify with you, has the lower cost actually justified higher returns over the last couple of years since we've been watching it?
Tough to say that, but I would say that besides lower cost, there is another thing to Quantum Long-Term Equity or similar thing which is visible even in HDFC Top 200, is that they actually reflect a strong value orientation, and many a times these funds struggle, and they compensate for it in a full market cycle. So from that standpoint, I find there is similarity between both the funds. Yes, one thing which I dislike about Quantum Long-Term Equity is that it is not fully invested at all times, which my understanding is that when somebody is entrusting a fund, wants money to an equity fund, then that is what is expected of it. But here the fund manager tries to not be fully invested in equity to optimize return, and that has not worked out nicely for this fund. So one is the cost part of it, the other is strategy. And it's a conservative equity fund, and in a full market cycle, it should do well. Long-term returns look very well in place, and so yes, an investment worth carrying on.
The last two funds on his list, SBI Blue Chip and L&T Prudence, Dhirendra, they are both very, very good performers. Given what the rest of his portfolio looks at this point, will these two make a good combination, a good addition to that portfolio?
I really wonder that L&T Prudence or HDFC Balance, they fit into a portfolio which is for next 15 years, and more so when you have your investment elsewhere. This is the only growth investment, so it should not be there in the first place. Otherwise, L&T Prudence is a good balanced fund. Then comes SBI Blue Chip. How good a large cap fund it is. It has come on the forefront. It is an impressive large cap fund worth investing.
All right, Dhirendra, one very, very quick question for you before we let you go this week. 30-year-old Pranav Sharma has written in another NRI. He wants to begin investing 10,000 rupees a month in mutual funds for the long term. Wants to start an investment plan for his retirement. So he's 30, that gives us at least 30 years. And he also wants to save on tax. Now, he hasn't told us what tax he's paying, given he's an NRI. But among the tax saver funds, Dhirendra, what would you recommend long term for someone planning their retirement 30 years away?
30 years away, one has all the time. One should also be willing to assume great risks. Because the risk is not a significant risk, given that you get locked in for 3 years and the interim volatility should not bother you. Also, it forces you to think long term. At least with a 3-year time frame, because many times investors, they see a 5% decline and they're tempted to cash out their investment at the wrong time. So I would say consider the aggressive tax saving fund, something like the Reliance Tax Saver, which we discussed earlier, or Axis Long Term Equity.
On your screen right now, Reliance Tax Saver and Axis Long Term Equity. These are two funds that you can use even if you're going to start your investment this year for the next 30 years. These are good options. They'll also save your tax. Virendra, thank you so much for joining us on the show and answering all of our questions.
Thank you.
Welcome back. You're watching Investors Guide in ET Now. It's time to take a very close look at tax, and we have Suresh Surana, who's standing by to help us out. Suresh, thank you for joining in. Vasco George writes in from Hong Kong. Hi Vasco, thank you for tuning into the show in Hong Kong. Now he plans to continue holding his stocks and mutual funds in Hong Kong even after he returns to India. He wants to know what the tax implications will be once he becomes an Indian resident who's holding Hong Kong domicile securities. Well, Suresh, can you help him out?
Yeah, so Mr. George, since you have been non-resident and now you are returning back to India, you need to see from two different perspectives. One is the exchange control and second is the tax perspective. So under the exchange control regulations, whatever assets you have acquired while you were a non-resident, you are allowed to continue to hold them. So it is not an issue from exchange control perspective. As far as the tax regulations are concerned, it depends upon your status once you come back to India, whether you are resident and ordinarily resident or resident and not ordinarily resident. So for instance, if you have been outside India for 9 out of the 10 previous years, then you will be resident but not ordinarily resident for the first 2 years, in which case your income arising outside India on this mutual fund and other assets will not be subject to tax in India, and you don't even need to disclose that in your tax returns in terms of foreign assets. Once you become a resident and ordinarily resident, you need to show the income from these assets in your tax return because your worldwide income is subject to tax in India. You also need to disclose these foreign assets specifically in your tax return. I would just like to share with you that there is a new law which has come into force about the foreign assets and foreign income, and if you do not disclose those, the penalty can be as high as rupees 10 lakhs just for non-disclosure, apart from the penalties for concealment. So please ensure that once you are a resident and ordinarily resident, you reflect the income from these assets, and you are also disclosing your foreign assets properly.
Our next question comes in from Ashwin. Ashwin's written in from the Middle East. He tells us he's put aside some money which will serve as a deposit for a home that he plans to buy over the next 1 or 2 years. He wants to know if he should be using the NRE deposit that gives 8% returns annually without any taxation, or should he use a liquid fund? He wants to know what the tax implications are of using a liquid fund. Well, Suresh, we have to remember here that he's planning to buy this house in India. So in that case, the money will have to be moved to India eventually. So what would be the better of the two options for him?
Yes, in case you are looking for investment only for a period of 1 or 2 years, the NRE deposit might be a very good option. You will get an interest of about 8.25% or so, and that interest is totally tax free in the case of non-residents. So under section 1015, that is completely exempted from tax. In case you want to invest in the liquid units of mutual funds, you will get the benefit of concessional tax only if you are holding it for more than 3 years. Then it will be treated as a long-term capital gain. You will get benefit of indexation and the rate of return. It is not fixed rate of return, unlike the case of NRE deposits. The rate could be in the range of 9 to 9.25%. So slightly higher rate, but it is subject to tax. So you really need to look at your time perspective. If you are going to hold it for more than 3 years, maybe you can look at the liquid units, but not otherwise. Otherwise, NRE deposit is a good option.
Last question on the show comes in from Ireland. Vinod writes in. He tells us he holds the OCI card, but he's a citizen of Ireland. He's had a passport for 2 years, works in the UK. He plans to open a demat account in India and start investing in Indian stocks. But we'd also recommend you invest in mutual funds, Vinod. He wants to know which country he will have to pay capital gains tax in and what the tax implications are in India, in the UK and in Ireland. Suresh?
First, I presume that although you are mentioning about OCI, which is the Overseas Citizen of India, you are also a non-resident of Indian origin, which means you held Indian passport at some point in time, or either of your parents or grandparents held the Indian passport at some point in time. If that is the case, then you can invest by opening a portfolio investment account under the PIS scheme in India, and the income in terms of taxability, it really depends upon if you are if you are holding the shares for more than 12 months, then the long-term capital gains in India are exempt from tax if they are sold through the stock exchange. If you are selling within a period of 12 months, then there will be a 15% short-term capital gains tax on that. As far as the taxation in Ireland is concerned, I believe it is taxed based on the period of stay and residential status. And if you are a resident of Ireland, then you might have to pay tax on this income and you will get credit for Indian taxes against that. If you are a resident of UK, in UK they have a concept of resident but not domiciled also. So, for example, if you are not a person who is of UK origin or was born in UK, you can claim the status of resident but not domiciled, in which case your income outside the UK will not be subject to tax. But I think you will have to seek specialist advice in your respective country, in Ireland or in UK, to take a final position. As far as India is concerned, you can claim long-term capital gain exemption after 12 months if you sell through stock exchange. Less than 12 months, pay short-term capital gains tax of 15%.
All right, so that's a wrap on Investor's Guide. Now remember, any question that you have, whether it's about tax, whether it's about a home loan, or it's simply about managing your money and beginning to start saving, you can write to us. Email ID is at the bottom of your screen. You can reach us on our Facebook page, and you can reach me personally on Twitter. I always look forward to hearing from you. Tune in next week and catch Investor's Guide. Thank you for watching.